Hi kiddos. If you will pull out your printable exercises for unearned revenue, let's work through that second problem together. Ross Builders Group agreed to build a custom building for ABC Corp. Because of the specialty materials, Ross Builders required an advance payment of 1/4 of the estimated total cost. On April 1st, ABC paid Ross Builders $250,000 toward a $1 million final billing. On April 30, Ross Builders sent ABC a progress billing for their project. The progress bill indicated that they had completed 1/5 of the building in April. Okay, so first off, let's make the entry for Ross Builders when they received the check for $250,000 from ABC on April 1st. Okay, so April 1st, we would have made a deposit. I'm Ross Builders. I got cash for $250,000, and I haven't done any work for them yet, so I'm going to credit unearned or deferred revenue. Okay, then it says make the entry to record the information from the progress billing Ross sent to ABC on April 30 in order to do the April 30 financial statements. Okay, well, it'd be nice if we were looking at the actual bill, but I know what was on it. They said they had completed 1/5 of the building in April, so they've earned 1/5 of that $1 million. So that means they've earned $200,000, even though they've already gotten $250,000. So they're not asking for more money yet, right? Because they haven't used up the deposit yet. But we do need to move out of unearned and into earned revenue the amount they've earned. Okay, so I am going to debit to reduce unearned revenue for $200,000. And I'm going to make a side note over here that is 1/5 of $1 million. Okay? And I'm going to put it into revenue. $200,000. And of course, if I'm a construction company, I've also got costs, direct costs, and I would record those also. But right now, we're just worried about the unearned revenue. Okay, super. Now, if you will pull out the printable problem I posted for you for warranty liabilities. Okay? And let's go ahead and do the first one. And then you're going to do the second one for me, I think, or did I ask you to do it the other way? I think you are doing the first one, so let's do the second one together. Okay, on September 11th, Home Store sells a mower for $500 with a 1-year warranty that covers parts. Warranty expense is estimated to run 8% of sales. Okay, so what that means is at the time of sale, okay, at the time of sale, we need to go ahead and book a reserve for warranty work. Okay, so when I make the sale, let's just assume on September 11th that we sold it for cash. So the home store would debit cash for $500 and credit sales for $500. They would also debit warranty expense for 8% of $500. 8 times 5 is 40. 8%, 10% would be 50, so 8% would be 40. Credit warranty liability. Now, the reason warranty liabilities are kind of like the allowance for doubtful accounts is because when we find out that we are going to have to fix something, we don't record the expense at that time. We've already recorded the expense. We're going to take anything we have to fix, we're going to take it out of the liability account. Okay? So we just believe that we're going to have to make this much repair. Okay, so then we get to July 24th, and sure enough, somebody does need to bring it in for a repair, and we spend $35 on it. Okay? So on July 24th, which would be, of course, the next year, this was 14, this is 15, they bring it in, okay? And basically, we are going to debit against the liability account because we've already put the warranty work in the same period with the sale back in September. And then those parts are going to come out of the parts inventory account. So notice that I didn't call that repairs expense. I already reserved for the potential of having to fix the mower, so I'm taking it out of the liability and out of inventory. Okay? Super. Now you guys take a shot at working the problems that are in the forum. Thanks.